We take a look now at Bain Capital, the private equity firm once run by GOP presidential hopeful Mitt Romney. The company let employees invest in their IRAs in the companies and take over deals. We're going to get more on this from Mark Marimont right now. He's joining us from Boston. Thanks for being here. You know, a lot was looked at when Mitt Romney made his financial disclosures over the amount of money in the IRA. I guess you quoted in your story about $20 to $101 million. Certainly a little unusual just for the amount that was in there. Tell us how this came to be in the Bain Capital's policy.
Well, it's an IRA, an individual retirement account, is an account set up for workers to save for retirement, and it's a tax-advantaged account. The question was, how did Mitt Romney manage to get up to $100 million in his account? And the campaign won't really say. We took a pretty close look at Bain Capital and how this might have been possible. We don't know for sure, but they had a very unusual plan in which they allowed employees to co-invest in their deals, as it were. They would take over companies and restructure them and hopefully improve them and then sell them for a profit. But the way that this happened was extremely complex, and the co-investment plan was complex, but it ended up producing, in some ways, enormous returns for the IRA accounts of many Bain employees. And we found some examples. One deal produced about a 5 times return for Bain itself and for its investors, which is very, very good. I mean, you don't see that type of deal. But the IRA accounts of some Bain employees went up 35 times in their investment in that deal. And there was another deal in which, for a contact lens company called Wesley Jessen, Bain, just a huge home run, produced about a 46 times return for its investors. But because of this complex structure that Bain set up, the IRA accounts of Bain employees saw a 1,000-fold gain on their investment in that company. That's 100,000%, which is quite remarkable. And it was a very complex scheme involving two different types of shares, which we can certainly get into a little bit more.
Well, Mark, you bring it. This is a complex sort of scheme, but the idea of private equity executives or workers investing alongside with their company is not unusual. I think the unusual thing here, and from what you're saying, is that there's nothing illegal about this, is that they structured it as an IRA. And most of us think about an IRA as some place where you have a couple mutual funds or you put it, your rainy day savings in there. But this is like big time finance, and of course the numbers you're talking about are significant.
Yes, now you're absolutely right, and there was in fact nothing improper at all about investing IRA money in private deals. What was a little unusual about this is that Bain, when it took over a company, would set up essentially 2 classes of shares. One of them was like a preferred share, and then the other one was this very, very inexpensive kind of common stock that had low value. Bain set a very low value at the beginning, so that if I could invest $5,000 in that low value stock, if the deal went well, that stock actually took the lion's share of the profit. So a $5,000 investment in Sealy mattress could turn into $170,000 in not a very long period of time. And even though the actual deal didn't go that well, so the real question about the way this has happened from a tax perspective is that I've talked to some very serious tax attorneys, including at some big white shoe firms in New York, who say that there are some fundamental questions about the way Bain valued these super cheap shares and whether that was done properly. If it wasn't done properly, that could raise some significant tax issues for Bain executives.